during this hiking cycle, um, the economy was more desensitized to rate hikes than many people expected. Back in 2022, I would have thought it'd be a little bit more sensitive to it. It was by early 2023 that I started to realize that the economy is probably going to be pretty desensitized to them. And the main reason for that is because we now have over 100% debt to GDP, and deficits are larger, like fiscal deficits are larger than bank loan creation in a given year. So we've kind of moved from kind of credit creation more toward fiscal driven, fiscal dominance type of situation. And a lot of that federal debt is fairly short term. The average duration is something like 6 years, but it's front loaded in the first couple years with a tail that goes out to 30 years. And so when they raised rates, it's very different than raising rates when you have 100% debt to GDP versus 30% debt to GDP back when Volcker did it. And so by raising rates, they greatly increased the fiscal deficit in the form of interest expense. But the private sector had locked in a lot of fixed rate debt for very long terms. So homeowners, plenty of 30-year mortgages, and we don't really see that as much internationally. The US has a higher concentration of long-term fixed rate mortgages than most other peer countries. And also our corporations locked in a lot of debt at 10, 20, 30 years, again at low fixed rate. And even compared to European countries, US companies do use that bond market more than bank lending. And so again, they locked in rates even better than many global peers have. And so the private sector was particularly resistant to rate hikes, while the rate hikes blew out the fiscal deficit. The areas that were most negatively impacted were small businesses because they're more reliant on bank loans, shorter duration bank loans, as well as things like commercial real estate, junk bonds, kind of industries that don't have that long fixed rate, low interest rate debt. So when we kind of go to the other side of this and we enter rate cuts, we see softer economic data. We already saw that there's a bit of a global cutting cycle starting in other central banks. When the US does join them, I think there's a good case to be made that, especially the initial several rate cuts are not going to be particularly impactful for a lot of economic entities in the economy, because unless mortgage rates go to a lower low, which I doubt they're going to do, there's not a lot of refinancing that can happen. So whenever you have a lower low in mortgage rates, it unlocks a lot of homeowner refinancing. I don't think that's going to be a significant variable this time, as well as corporate debt. A lot of that is already termed out at lower rates. So if you don't see a lower low in investment grade corporate bond yields, again, refinancing is just not super impactful there. Now, it would potentially be helpful for small businesses that have that shorter duration lending, borrowing, and it could be helpful for some of the very troubled commercial real estate. But overall, I think basically there's going to be some degree of lack of sensitivity to rate cuts on the economy.
Data shows that despite the Federal Reserve's aggressive rate hikes, the US economy remains surprisingly desensitized. Financial expert Lyn Alden points out that with over 100% debt to GDP and large fiscal deficits, the usual sensitivity to rate changes is dulled. When the Fed switches to rate cuts, the impact won't be as powerful as before. Homeowners with long-term fixed-rate mortgages and corporations with long-term debt are locked in at lower rates, meaning the expected boost to real estate could be minimal. Alden explains that unlike previous cycles, the initial rate cuts won't significantly lower mortgage rates or spur widespread refinancing activity. Small businesses and commercial real estate might see some relief, but the broader market may not feel the benefits. Alden warns that unless mortgage rates hit a true lower low, significant refinancing won't happen, limiting the economic boost. She emphasizes that this lack of sensitivity to rate cuts marks a major shift from past trends, where lower rates typically stimulated the housing market and corporate borrowing.
Well, so we've seen banks, obviously they've choked a little bit on long-term treasuries and longer-term mortgages, especially because the low interest rates on fixed mortgage, people are not really prepaying them. They're at a very high rate. They're kind of pushing that as much as possible. So basically, they've effectively extended the duration of those mortgages in many cases. And so that's generally what we see on the. It's been troubling for certain banks. And in general, we see the refinancing numbers and we see the origination numbers. And so in the current period of higher rates, there's been fairly low mortgage originations, which means that if we do get lower rates and we get lower mortgage rates, like sure, around the margins there is some refinancing activity that could occur from people that were kind of unfortunate to lock in these pretty high rates. But that's a pretty small segment of the economy. So I think basically if you saw rate cuts, you'd see a little bit of help to the banks that have been a little bit pressured. You'd see help to some of these kind of more rate sensitive industries. But it would be pretty unimpactful, I think, for homeowners and corporations, even more so than prior rate cutting cycles, because of that lack of a lower low, potentially for the first time in 4 decades. Yeah, I think that's probably a risk. So far in the housing industry, we've seen that most houses outside of very cyclical markets, their house prices have stayed elevated, but that turnover has decreased a lot. I expect that probably to continue. I think a key difference is that refinancings wouldn't really occur unless there's a true lower low, except for around the margins. Whereas some of the existing sellers could come back to market even if you don't get a lower low. If mortgage rates get, kind of even comparable to where they were before, even if they're a little bit higher, that potentially does unlock some sellers that could sell and then get a new mortgage that's maybe a little higher than what they've already locked in. But if they're motivated to sell, if they want to move, if they have, things they can't control, that could happen even without a lower low. So I wouldn't try to judge that too heavily. But I do think that I have a higher conviction on that refinancing factor. And that's in coming out of recessions, that refinancing factor is a non-trivial variable. It's one of the more impactful areas that monetary policy has in terms of stimulating the economy. Because when someone refinances a mortgage, it's basically a free lunch for the refinancier, because they're locking in lower rates, they're not really taking any more debt per se. And it's just kind of all upside for them. And that's just not something that's going to be around. Now, there could be, we could see increased activity around second mortgages, for example, but those are less stimulatory, especially on a sustained basis, because they do involve taking on more debt. Well, ever since the global financial crisis, we've seen kind of a rotation from private debt to public debt. And what I mean by that is that even though absolute private debt levels are higher than they were, back then during the global financial crisis, private debt levels relative to GDP are actually lower. They kind of started going sideways to down, and it was public debt that really took off. And I expect that probably to continue going forward. And when we look at things like, for example, debt relative to house value, that's also still on the somewhat the low side. So, for example, in the past several years, homeowners' equity went from, say, 20 trillion to over 30 trillion. So there is that extra equity that some of them might be seeking to lever for cash flows with things like second mortgages or when they kind of move and take out a new mortgage. But I think that would be somewhat muted overall. We did see that, for example, Freddie Mac is going to start buying secondary mortgages, which can add liquidity to that market and potentially result in more originations for that type of activity. But overall, I would expect that to be a smaller factor than what we've historically seen with refinancings. So I think we'll still see absolute private debt levels continue to increase when you look at it on a dollar basis. But I do think that we're kind of more underway in that private to public sector rotation. And we've seen that in other countries too. That's basically what happened to Japan during their stagnation years. We're seeing it in the United States in the post-GFC years. We're kind of seeing it in China with, for example, a lot of their housing debt kind of just slow motion train wreck going on, and more debt kind of going on the sovereign level of China. That's a pretty repeated pattern that we're seeing, and I don't think we're done that rotation yet. Despite the fact that entities like Freddie Mac might be adding liquidity to that industry, I don't think there'll necessarily be a lot of volume for those types of second mortgages, because I think from a homeowner perspective, there are legitimate concerns around taking on that extra debt relative to property, and I don't think the risk appetite will be particularly high for that.